Hello, let's start discussing a very important topic, and it is an high demanding field in the market. That is a quant analyst for the quant risk management for the beginners who are looking to demonstrate the quant domain. So these slides, these videos are very helpful, and that will give you some understanding in the field of quant analysis. So let's start to discuss this topic. So the topic is a quant risk management for the beginners. Okay. So basically, what is a quantitative risk management and where it is used? So basically, quantitative risk management is a process of using the mathematical and the statistical technique to measure and manage the financial risk. So bank or financial institutions or the insurance company or the hedge funds organization required how to they wants the person to use the mathematical statistical technique or the functional knowledge or the AIML technique to measure and manage financial risk with it is an approach with the data driven approach to these things, and it is also instead of just talking about the risks we use numbers to understand their the potential impact. It is not the only number we use, not only the risks we use in numbers, the techniques, AIML techniques, or the the statistical technique or the mathematical techniques define the potential loss on that portfolio or on the loss on that the investment like it is at the investment for the stock investment or the fixed income investment or the forex investment, and the goal is to provide the objective data back insights to make the smarter financial decision of investment. So that's the thing in the quantitative risk management. So let's on the next slide. So what is it so important? Why the quant risk management or the quant techniques are so important in the market, and why the hedge fund company, big financial institutions, banks, insurance company, broker firm now hiring for the quants profile, and why they are giving more salary. So it is an objectivity. It helps us to remove the subjectivity, good feeling, and get the risk assessment. It talks about the numbers. It helps us to measurement. It allow you to put the potential losses. It helps the organization or the firms to get the number how much the losses they can bear at certain confidence level or certain statistic technique, and it is licensed by the Google will give you the that will be the best thing to manage your risk. And the quant techniques or the quant things will help the financial institution or the portfolio manager or the compliance team or the teams to make a better decision with the data driven with the with the data from decision from the data, and it helps to allocate the capital more effectively and set clear risk limits. So you can use the mathematical techniques, statistical techniques, artificial intelligence and machine learning techniques to make a clear decision and the risk free decision, and get more interest or the more income from your investments or from your portfolios, and optimize the portfolios. It helps to proper optimize your portfolio. And then the regulatory compliance, regulator often require the financial institution to perform the quantitative risk assessment to ensure the stability. So regulatory itself forced to the financial institution or the hedge funds or the banks or the insurance firms to use the quantitative technique, and regulator itself give you the some quantitative methods like FRTB or the to how to calculate the the expected shortfall, loss given default, risk weighted asset, how to calculate the conditional VaR. That things or that method itself regulatory will define. The Basel committee as their some rules and regulation and some techniques, or bank is define its own internal techniques to calculate these things. So that's why it is an most important things. And then discuss on the key concept in the quant risk. So these are the four are the key concepts, the building blocks in the quant risk. First one is a market risk, second one is a credit risk, third one is the operational risk, and fourth one is a liquidity risk. So let's discuss on the market risk. So the market risk is a losses due to change in the market prices like a stock price or the interest rate increase or the decrease, or the forex amount will get decreased, or the cryptocurrency, if you are the portfolio in the cryptocurrency, if their prices will changes, what are the impact of that even or even on your portfolio. So that calculation or that analysis we will do in the market trick. So how much the market will get changes, or the market impact, or the economic things can impacted on your portfolio. So that analysis or that calculation we will do in the market risk. So then let's discuss on the credit risk. So basically the credit risk is that the borrower will not able or not ability to repay your loan or the meet their contractual obligation, or not able to meet their contractual obligation. So if bank has give the home loans, personal loan, mortgage loan, car loan, different kinds of gold loan to give their the borrowers, and they find they has some risks, the loss given default, exposure or default. So they has some risks, the borrower may default. So that calculation of these risks, or they are the methodology to calculation that risk, so that comes under the credit risk. So borrower may be default. And then the operational risk, so bank has a use of the operational risk. So the risks of losses from failed the internal processes, the process is defined by the bank, or people are not working as the expectation of the bank, or the system failure, or people may do the fraud. The Nirav Modi fraud, or the Vijay Malla Vijay Malla fraud, or many frauds in the many very organizations that are the operational, the risk fraud, or this done by the people's, that not done by very well there the processes or the systems. So then the liquidity fraud of risk. The liquidity risk is the risk of not being able to buy or sell an asset fast enough to avoid the losses. So if you go in the bank, and if you have the 10 lakhs FD or 1 CR FD, so you can anytime go and redeem your FD. If bank is not able to give you that 1 lakh rupees, so what kind of that risk? That is a liquidity risk. So whenever you go in the bank, you should immediately get your, liquidate. So loss given, there is the CGR or different ratios that regulator will provide, and that should maintain by the banks to the liquidity risk factor. So let's move on the next and very important, the value at risk. So it is a key matrix for the measure of the risks of all these types, and it is defined by the bank, and it is defined by the banks. So what is a value at risk? So basically value at risk is also called as a VaR, and VaR is a statistical measure to quantify the maximum expected loss of the investment over a specific time period with the given confidence level. So that will give us how much the maximum loss the bank or the financial institution or the insurance firm or the hedge fund can take at a given or the certain time period with the certain confidence level which we take. Suppose, for example, a portfolio has a 1 day 95% VaR with 1 million. So if you have the 1 trillion or the 100 trillion or the 100 million portfolio, that give us the 1 day loss of a 95% confidence of 1 billion. So that means, or this means, there is a 95% chance of that portfolio will not exceed 1 million in a single day. So 95% we are confident, 95% we can say that that portfolio will not loss or not give the loss beyond the 1 million in a single day. And conversely, it is meaning that there is only 5% chance the portfolio could give be the greater than or more than the 1 million loss we can take from this portfolio. So there is a three important factors while we are calculating. First one is a duration, second is a confidence level, and the how much the amount we can get the loss from that portfolio. So these three we are required to calculate the value at risk, and there is a three different method to calculate the value at risk. So first one is a historical method. So use the past data to predict the future losses. So in a historical method, we take, the historical value or the historical return or the historical gains to calculate the historical VaR. And third one is a parametric method. So measure is, normally distributed to calculate the VaR. So we use the mean of the return or the normal distribution of the return to calculate the VaR and to get the parametric method. It's and then the Monte Carlo simulation method. It is and the most used method. So it is and the it is we calculated by Excel. So use a computer model to simulate the thousands of possible outcome with providing the mean and standard deviation of that portfolio, and calculate use the rand value or the random functions to calculate the random value, and then calculate the value at risk of that portfolio. It may be calculate the one portfolio, two asset portfolio, three asset portfolio. So that's are the different techniques that we use to calculate the value at risk. And next are the most important, and regulatory will support that, the trace testing and the scenario analysis. So testing is the extreme limit. So let's discuss what is a stress testing. So what is the basically stand for the stress testing? So stress testing is a simulation technique used by to determine how a portfolio or the finance institution will perform under the extreme but plausible and market conditions. So you can consider the trace scenarios, and the scenarios that are considered in the trace, and you use the AIML techniques, or the mathematical techniques or statistical techniques to define the trace and identify how much the portfolio or the financial institution will perform in that certain conditions. And the purpose of doing the trace testing or scenario analysis is goes beyond the normal market fluctuation to reveal the hidden value vulnerabilities that stand the model might miss, vulnerabilities that model might miss. So we don't know what will happen in the futures. So we can consider the past scenarios, or the random scenarios, or historical scenarios, or economic scenarios, or the hidden scenarios that will be provide the data or the financial institution, and then we calculate how that portfolio or how that institution will work in that scenario. We know that the 2008 financial crisis or the COVID-19 crisis or suddenly decrease the 40% of the stock price. So we don't know what will happen in future. So that kind of scenario we feel apply in that the portfolio to get the understanding. So there is a hypothetical scenario like a sudden global economic recession or the sudden price will decrease. How would the stock perform if the market drop the 40%? If the interest rate will increase the 2% or 3%, so what will be impact on the portfolios, and how still enough capital meets the or obligations can we achieve the target? So that's thing we will do in a trace testing and scenario analysis. That's the very important things for the quant field. And then the role of quant. So what is the role of quant in the banks and financial institutions, and what is the exactly quant will do? The math beyond the money is the quants. So the job, the quantitative analyst or the quant analyst, the use and they will use, or they are able to use the advanced mathematical and the statistical and computer programming techniques to solve the complex financial problem, to give the solution for the financial problem. They are the thinking beyond the mathematics. They are expert in the mathematics, statistics, computer science, and the AIML techniques or the quantum computing techniques, and to provide the solutions for the complex financial problems. And they are these the key responsibilities of the quant role as developing and testing the risk models to build the model that will solve the business problems or the financial problems of the financial institution, and creating the trading strategy or the trading algorithm, and to provide the trading beyond the human interactions, and analyze the large data set to find the hidden pattern or the find the patterns in that data set, and communicating the complex findings in clear way, and communicating with the complex and complex things with the clear way. So let's discuss on the light slides. So what we are conclusion from these videos, and what we are take, and what are the understanding from this video. So Quantitative risk measure provide a powerful data-driven framework to understand the financial risks, and that will help us to understand what are the financial risks in the market, like the market risks, credit risks, liquidity risks, operational risks, and what are the quant techniques, what are the quantitative method, what are the mathematical method, what are the statistical method, what are the machine learning or artificial intelligence techniques we are going to implement in that the financial problem or the quantitative form of financial problem, and to build the optimum portfolio or to build the optimum strategy to get the resolve the problem. And let's the tool like VaR, stress testing, scenario analysis help us to measure and prepare the potential losses of portfolio, to build the AIML oriented product that solve the financial institutions problem. And it is a crucial field for anyone working in the finance and get the higher salary in that field. Everyone get the higher salary, and fast performance improvement program is in that field. So and it rely on the blend of mathematics, programming, and the financial knowledge. So it is an the area where you can apply your mathematics and the programming knowledge and the statistical knowledge. So thank you so much. If you have any open points or any open questions, or if you want more understanding that fields, so please like and subscribe my channel, so that will motivate me to create more and more such videos for you guys. And if you have any understanding, or if you want to some certification or knowledge in that field, so do like and subscribe, so I will help you where to get prepared in that field. So thanks once again. Thank you.